Welcome to TheoTrade. This is Don Kaufman. June 8th, 2022. 8 minutes left inside of this trading session. Spoos off about 45 handles, just south of about a 1% decline inside of the S&Ps. The Nasdaq is strong on a relative basis, but I'm going to tell you, really what the entire marketplace is about to boil down to, really the big print of the week is CPI coming out. I got to tell you that bonds are just creating the perfect storm for Friday's CPI. I'm going to explain that and much more here on this evening's video. So once again, the S&P is trading in and around this 4111 handle. Now, for those of you that don't necessarily kind of tune in to TheoTrade on a day-to-day basis, we have really specific, very definitive levels that we happen to look at. Again, I'm not much of a market technician. I'm much more of a quantitative trader. So there's like a central point in trade, a place the marketplace is just literally drawn to, what we kind of term a gravity point here. For right now, it's 4111, and a better way and a more effective way to actually look at this is on a 30-day 1-hour chart inside of the S&Ps. And just take a quick glance. I'm actually going to zoom in for you here. And what I want you to see is right where we presently are, okay, in this neighborhood here of this 4111. It is it's neither the upper nor lower. It's pretty much the central point of trade that has, I mean, listen, we've been trapped inside of a range. I know Corey was talking about that extensively yesterday, trapped like a rat in a cage over here. You look at this and you think, well, it's towards the lower edge of it. Absolutely. But one point to be made from where we presently are at and near this 4111, any trade that's actually transpired below the 4111 has been like the Excel train to the downside of the range, the downside of that range being right around 40.75. Now, that's a level that you should probably pay a degree of attention to, because cracking below, again, that 40.75-ish would be, well, the S&P is actually slipping off into the abyss. What's the abyss actually amount to? Again, when it comes to levels, I'll be very, very specific over here. We start breaking through 40.75. It's almost a perfect and straight shot right back down to the 39.31 handle. And that is a very definitive gravity point. And you look at the marketplace right now, you think, there's no way. Come on, man. We're trading much closer to this level. And by the way, the level I'm actually pointing out up there happens to be none other than 42.11. Again, down to the downside of this 39.31. Okay, so it's kind of stuck between a rock and a hard place. But the range that we're presently seeing, right? Let's not diminish the fact that the range that we're seeing over the last almost 2 weeks of trade has actually been rather extensive. Like, look at some of these candles. As I zoom in once again, you're getting 100-point plus swings on a day-to-day basis from absolute low to high, and then some. So the volatility and the overall volatility in the marketplace, it kind of like, it's diminished, but has it? I mean, has that volatility really diminished? Now, well, of course it has. The VIX, forget about the VIX for a second. We're still getting a huge amount of price action in the overall marketplace. We're just not going anywhere fast. Okay, and it's actually why I wanted to bring up bonds in here, because I think it's of critical importance. In fact, I'm going to talk about bonds, and then I'm going to jump back over to volatility of the overall marketplace. Bonds, frankly, have kind of fallen off the radar screen in the last couple of weeks of trade. And again, the reason that I wanted to mention bonds is they're very, very close, once again, to the lower edge of the range. And that's why I say it really is kind of that like perfect storm. You're like, well, what's the issue? I'm going to remind each and every one of you that's been watching bonds with me for a considerable period of time, this wild sell side activity that happened in, everything from late April into kind of, mid-May, that wild sell side activity in the bond market sparked vicious and unrelenting sell side activity in none other than tech, especially big tech, the monsters of tech, if you will. And then the sell side activity became so extreme in the S&Ps, the trade literally turned around and started buying bonds as the S&Ps were actually progressing to the downside. So it was all of a sudden it went from we sold off the bonds, rising interest rates is going to kill tech. Then all of a sudden they turned around and they go, we have to buy bonds because the markets are getting killed. And then things subsided. And as things subsided, kind of lost track of the bonds a little bit. I mean, I watch them on a day-to-day basis, but here they are, and they've slipped right back down to the lower edge of the range. Normally, I'd be like, all right, they're primed. These things could actually break to the downside. But that coupled with the fact that CPI is coming out on Friday morning, and you got yourself a making of some big boy risk in here. Check out the TNX. I find this one kind of interesting. The TNX, this is actually the 10-year. The 10-year is butting up against some of the very recent highs, and far be it for me to get in the way of this thing. I kind of think this TNX could end up like on Thursday, right here, right around this 3.1% level. And then doesn't really matter what CPI news is. By the way, I don't care if CPI is hot, if it's cold. Like if you're looking for like an estimate, who cares? I can give you reasons. CPI can be burning hot, and all of a sudden the markets would tank on that. You're like, oh no, the Fed's going to have to cool off inflation. But I can also make an argument that if inflation has peaked and the CPI does start to come down, that could also be a little bit of a bearish connotation, because it doesn't look like the Fed right now is got the rhetoric behind them to cool off their rate increases in the quantitative tightening. So I can give you pretty much a bunch of different reasons why this is a really dangerous spot for the TNX, because all of a sudden we could explode right up to that 3.3% level in the TNX, and everybody all of a sudden starts screaming about, yeah, forget about inflation. Now you got higher rates coupled with inflation. Don't worry, it's only going to be $5 or $6 gasoline. It's a party, people, and everybody seems to be invited over here. It's not a comfortable place, though, for the bonds, right, to be where they're presently trading with CPI coming out on Friday. Now, let's switch it back over to volatility, because this is the one where everybody's looking and they go, yeah, volatility doesn't care. Volatility, of course it doesn't care. We haven't done anything astounding. We haven't done anything as of late in this marketplace that the market hasn't seen. I mean, again, legitimately, if you're going back to the S&Ps for a second, you got 1, 2, 3, 4, 5, 6, 7. This is now the 8th trading session. So as I said, we're working our way into 2 weeks, 2 full weeks of trade, okay, with a range that's massively unchanged. What do you think was going to happen in volatility? But you might be missing something. VIX doesn't budge. Volatility doesn't budge. My guess is that tonight skew is going to creep up. Skew has been bottom of the barrel. Why do I guess that? Look at VVIX, the volatility index. Oh, somebody is starting to hedge. So they're waking up a little bit, and there's actually some hedging activity transpiring in this marketplace. So now you have a little bit of a cause for concern, right? So you're actually seeing somebody starting to hedge out there, and the dollar kind of picked its head up just a little bit. There is the closing bell. So the volatility, picks up just mildly, and the volatility we're looking at is the volatility of the volatility, right? The volatility of the VIX. Nevertheless, okay, some very marquee players, your Facebook, your Google, your Tesla, they didn't even sell off at all today. It's okay. They're actually taken out of the equation. If we're going to see more sell-side activity, and I was mentioning this in the weekend update, that sell-side activity is going to come predominantly out of financials. And I believe it'll also eventually bleed over into the energy sector if we're going to have another major bout of sell-side in the S&P 500. Last but definitely not least, we finally got to it. This is now a split adjusted monster of tech, a brand new monster of tech symbol, which is out. Don't get too excited though just yet. So Amazon, all right, did its thing. It's now a $121 product. Why do we care? Because it screwed up our monster of tech symbol. We built a conglomerate symbol. It was like its own index product where we actually weighted Facebook and weighted Apple and weighted Microsoft and Google and Amazon all together to a wonderful thing that we call the monsters of tech. It was a great way of looking at massive tech, right? all of a sudden Amazon splits 20 for 1, it destroys our symbol. So what do? We rebalanced it. Okay, but recognize that Google is going to have its split coming up, just a few weeks out. So what are we going to have to do after Google splits? Hopefully that'll be the end of it, and we have to recalculate our monster of tech symbol. For those of you that need the monster of tech symbol, hey, okay, I'll be providing that live first thing in the morning, tomorrow morning, right in the TheoTrade chat room. How ironic, the S&Ps, once again, closing in and around the 4111. Again, very central point for trade. The very last thing I do want to just make very, very quick mention of here, and I've been very incessant about this week in and week out in terms of the SPX. The SPX, okay, what have we done on a week to date basis? And the answer is nothing. If you actually look at the central line here of expected move, we started the week in the SPX at 41.08. We're currently trading 41.15. Okay, I remind each and every one of you, we have a $100 expected move. We've come absolutely nowhere near the upper end or lower edge of the expected move. Why do I care? Because we didn't hit it last week either. It would be, okay, highly unusual to see 2 consecutive weeks of not hitting the upper end or lower edge of the expected move. So for what it's worth, Thursday, Friday, okay, no preconceived notions, but anticipate that we're actually going to break this 8-day range, okay, of 4111, and markets right now have the ability, okay, to explode as there is an extraordinary amount of gamma risk. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.